The Federal Reserve does not actually manage the economy. They think they do, but they don't. What they do with all this maneuvering interest rates is they really affect financial markets and perhaps the housing market. That's only like 4% of GDP.
Hi everyone, I'm Mark Gatto, co-CEO of Scion Investments and your host today for the Advisor Lab. And we come to you today from Future Proof in Huntington Beach, California. It's a great trade event for our industry, and I'm here today with our special guest, David Kelly. He is the Chief Global Strategist and Head of Global Market Insights for JP Morgan Funds. David, welcome to the Advisor Lab.
Very glad to be here.
Wonderful, wonderful. Is this your first Future Proof?
It is. And I'm probably overdressed for it, but that's the way it goes.
It's okay. It's a different type of event, different type of conference for sure. There's some amazing energy here. It's really a great gathering place for the RIA community and for sponsors of alternative investments. So I think everybody's really excited to be here at this time. It's a interesting time, if you will, for the markets. You have a lot of things happening. We have the Fed meeting this week, and everybody's focused on interest rates. So maybe we can start there. There is, obviously some debate as to how significant the rate cut will be this time around, and then moving forward, what the longer term views are. Be curious to get your views on where we think the cut's going to be this week, and then where is it going to be longer term?
Well, I know what I think they should do. It's a close call as to what they'll do, but I think lowering interest rates is a little bit like lowering a piano out of the second floor of a building. The only way to do it is slowly and carefully, and I really think they ought to bring rates down slowly. And it's not because I think that I'm afraid of them overstimulating the economy. I'm actually afraid of the opposite. If they cut rates quickly, then a few bad things happen. First of all, everybody says, why are they cutting rates so quickly? What are they scared of? What are they seeing that we're not? And maybe the threat of recession is bigger. Also, it cuts interest income a lot, and that actually squeezes the consumer. And then the third thing that's perhaps most damaging is, is the Fed done cutting rates? Oh, no, absolutely not. No, they're going to keep going. The more they cut, the more people are going to expect further cuts, so they're going to wait and see. And the three most dangerous words in economics are wait and see. When everybody decides to wait and see, what they see is not good. So I'm worried that what they need to do is bring rates down slowly. 25 basis points this week, maybe another 25 in November, another 25 in December will be okay. But just do it slowly. The economy is in pretty good shape, and just take it easy. I hope that's what they do, and by a very narrow probability, I think that's what they'll do. But we will see. They can easily get rattled here.
That's kind of one of those careful what you wish for, right? If things come down too quickly, there's a lot of things that can reverberate.
Absolutely.
I know that we've been always saying, certainly since interest rate hit their peak, that they would be higher for longer. And I think that your views on about lowering more methodically makes a lot of sense, especially given where we are in the current state.
Yes, because the Federal Reserve does not actually manage the economy. They think they do, but they don't. What they do with all this maneuvering interest rates is they really affect financial markets and perhaps the housing market. That's only like 4% of GDP. But I think it's important to bring those rates down to normal, but normal should be somewhere in the range of 3.5% to 4%, maybe on the federal funds rate. That's normal.
Sure.
That's what normal was before the financial crisis, and that's what normal is today. They ought to bring it down there, but they should be very reluctant, I believe, to bring rates down to zero again, because when you do that, you cause a lot of dislocation in financial markets, you cause a lot of stupid bets to be made. If the carrying cost of crazy is zero, people turn crazy, and you want to try and avoid that.
Absolutely. So, with that said, you have uncertainty around interest rates. You have certain people with some high expectations around interest rates coming down. You have a presidential election here in the U.S. That sort of signals to me that we should expect some volatility in the marketplace. How do you see investors, especially retail investors, how do you see them positioning their portfolio to dampen some of that volatility? We're here at an alts conference. Are they going to use alts? Is that sort of the direction that investors need to go?
I'm not sure the great mass of individual investors will do that, but I see a lot of growing interest among high net worth individuals who have a portfolio which is big enough to really want to be a little bit more sophisticated here. And one of the problems about great markets is there's an old saying that past performance is no guarantee of future returns. It's worse than that. Super past performance is a guarantee of mediocre future returns. And because a 60-40 plain vanilla portfolio has done so well for so long, As we map it out, we think future returns will be lower. And so people really need to look at alternatives as a way of boosting overall returns, but also as a way of diversifying, because a lot of the sort of zigginess of bonds, when the stocks zag, bonds zig, that's kind of gone away. And so you really need other things to diversify a portfolio. One thing that they're also really great at, I mean, they're great at a number of things. One of them is just not being fully correlated with the 60-40 portfolio or with equities. And so looking at things like infrastructure, real estate, private equity, transportation as ways of building income, building diversification, getting total return, but in a way that's not leaving you exposed to the same things that you're exposed to in a 60-40 portfolio.
Wonderful. And I think the exciting thing about what you just said is it's not just theoretical anymore, right? There are ways for retail investors, individual investors, to access alternatives in a thoughtful way. CityWire just came out with a article on interval funds and talking about the demand for interval funds and where they're seeing that coming from. And it's coming in certain strategies like private credit and infrastructure. Private credit has been all the rage recently. A lot of people are discussing it. There's been a lot of capital flowing into private credit. Infrastructure, a little bit newer in terms of access for the retail investor. Curious about your views on interval funds and then the various strategies that investors can look at to sort of diversify their portfolio.
Yeah, I don't want to speak about interval funds in particular, but I do think that there is more interest in all of those alternatives, and we're seeing a lot more interest. We produced something called the Guide to Alternatives, which is about 80 pages of different charts and tables, which is designed to explain alternatives to the average person, because one of the great barriers for individual investors is just understanding the jargon.
Sure.
And I think the industry tends to be pretty slow and sloppy about actually making this understandable. So what we're trying to do is making these asset classes understandable, but then we're also working with portfolio managers, frankly, and the portfolio managers are working on solutions which actually make sense, which actually provide great returns. And I also have my own podcast series called Alternative Realities, in which I really talk with people in the alternatives industry about their specific sector, and you can just learn. There's so much to be learned about the space.
Sure. Now, education is certainly a big part of the maturation process of the alternative space, and we like to think that we're at the forefront of that, because we do agree, right? These can be great solutions for individual investors, retail investors, but if they don't understand them, if their financial advisors don't understand them, it's really not something that they're going to get comfortable with, and I think that's our job as well in terms of getting that message out. And I'm glad to hear that you have a podcast that does that.
Absolutely, because it's, essentially you're asking somebody, give me your wallet, and I'll give it back to you in a while, and there may be more money in it or less money in it, but you're asking for an enormous dedication of trust. And I think the least we can do for individual investors is try to explain something as simply as possible. We shouldn't explain it more simply than possible, but we should at least try to make it clear when we can.
Right. So maybe one last question before we go, something off topic, but we're here at Future Proof, and I was asked the same question last year, my first year, sort of what's the most interesting thing about this conference you've seen so far?
Well, first of all, the fact that I'm completely dressed incorrectly is part of the story. But no, I think just the amount of energy and, frankly, a lot of youthful advisors. I see a lot. In my day to day, I tend to see a lot of older advisors and a lot of young advisors in this business. And I think there's a lot of energy in this business, a lot of growth.
100%. Well, thank you for joining us today.
Anytime.
We appreciate it. Thank you.
Thank you.
This video is for informational purposes only and should not be considered or relied upon as investment advice. It may not be copied, quoted, or referenced without Cyan Investment's prior written consent. Do not rely upon any opinions, predictions, or forward-looking statements contained herein. The views expressed do not constitute an offer to sell or a solicitation to purchase securities, nor do they constitute the endorsement of a particular asset class or investment strategy. Neither Cyan Investments nor its affiliates and/or subsidiaries warrant its completeness or accuracy. Certain information contained in this video may constitute forward-looking statements that may be inherently unreliable, and actual events or results may differ materially from those reflected or contemplated herein. Cyan Investments expressly disclaims any obligation or undertaking to update or revise any information included herein. The views expressed by the guests or participants are their own and do not necessarily reflect the views of Cyan Investments, LLC, or any of its subsidiaries, officers, or staff. Please be aware of the real risk of loss in following any investment strategy. No investment strategy or asset class referenced herein is intended to be construed as investment advice. You should make an independent, informed decision regarding any investments or strategies only after reviewing all relevant offering or disclosure documentation with your financial professional, and after considering your objectives, risk tolerance, and best interest before making any investment in any financial product. Registered personnel should review any business development initiatives addressed herein with their respective compliance and legal departments. Coverage of such topics should not be construed as compliance or legal advice. It is at the discretion of each respective firm if such practices are consistent with firm policies and procedures.